Hey everyone, welcome back to Corporate Decoder, the place where we uncover the hidden secrets inside company filings. Today we are diving into Rockwell Automation's latest update, and let's just say they've been busy arranging some new financing. This document, a Form 8K, is like a company's way of telling the world immediately about something important that happened. Think of it as a special bulletin that can't wait for the next regular report. And Rockwell Automation, a big name in industrial automation, has just put out such a bulletin. The important date here is the 18th of November 2025. This is when the main event happened, the day Rockwell Automation made a big financial move. Rockwell Automation Incorporated, based in Delaware, is the company we are looking at. Just some background details here. Their incorporation state and various filing numbers. Nothing too exciting for our analysis today. The company's common stock is listed on the New York Stock Exchange under the ticker symbol ROC. This is what most people think of as owning a piece of the company. Now we get to the meat of it. Item 1.01 tells us that Rockwell Automation has entered into a significant agreement, something that could really impact the company. Item 2.03 is where they detail the specifics of this new financial arrangement. This is the core of the announcement. So, on the 18th of November, Rockwell Automation signed a new credit agreement. This is a deal for $1.5 billion and it is set to last for 5 years. What exactly is a revolving credit agreement? Think of it like a credit card for a big business. They can borrow money, pay it back, and borrow it again as needed, up to that $1.5 billion limit. It's a flexible way to manage their cash flow. This is a significant amount of money, showing the company is planning for future needs or investments. And here is an interesting part. They have the option to borrow an additional $750 million. That is a lot of room to grow or manage unexpected situations. This shows a lot of confidence in their ability to handle more debt if necessary. This new deal is actually replacing an older credit agreement from June 2022. This is pretty common. Companies update their financing as their needs change, and as interest rate environments shift. The old agreement was also for $1.5 billion. And good news for Rockwell, they didn't have to pay any extra fees to end the old agreement early. This is a smooth transition, avoiding unnecessary costs. What will they use this massive pot of money for? The filing says general corporate purposes. This is a broad term, but it usually means things like day-to-day operations, investments in research and development, capital expenditures, or even acquisitions. It gives them flexibility. Now let's talk about the cost of borrowing. There are two main types of interest calculations here. The first involves a base rate plus something called a base rate margin. The base rate itself is usually tied to the prime rate at a major bank, like Bank of America in this case. It can also be influenced by the federal funds rate, which is the rate banks charge each other for overnight lending, a key indicator of short-term interest rates. The second type of borrowing uses the secured overnight financing rate, or SOFR. This has become a popular alternative to LIBOR, which is being phased out. SOFR is also influenced by short-term lending rates. The margin on top of these rates is what the banks earn for lending the money, and it can change based on Rockwell's financial health and market conditions. This is a really important point. The interest rate they pay isn't fixed. It is directly tied to the credit rating of Rockwell Automation. Higher credit ratings mean lower interest rates, and lower credit ratings mean higher interest rates. It is like getting a better deal on a car loan if you have excellent credit. So for the base rate loans, the margin can be as low as 0% or as high as 0.125%. For the SOFR loans, the margin is a bit higher, ranging from 0.695% to 1.125%. These are the percentages added to the base SOFR or base rate. The exact percentage depends on how well Rockwell is rated by credit rating agencies. Like any major loan agreement, this one has a lot of conditions, promises, and rules. Conditions precedent are things that must happen before the money can be fully accessed. Covenants are promises Rockwell has to keep, like not taking on too much other debt. Representations and warranties are assurances that the information is accurate. And events of default are specific actions or failures that could cause the loan to be called due immediately. These are all pretty standard for this kind of financing. The covenants or promises are designed to protect the lenders. They restrict Rockwell from doing certain things, like taking on a lot of debt secured by their assets or selling off major parts of the business unless they meet certain conditions. This is to ensure Rockwell remains a stable borrower. Here is a really key covenant. Rockwell has to maintain a certain level of financial health. Specifically, their earnings before interest, taxes, depreciation, and amortization, or EBITDA, has to be at least 3 times their interest expenses over a 4-quarter period. If this ratio drops below 3 to 1, it is considered a default. This is a common way to measure a company's ability to handle its debt payments. And importantly for shareholders, this new agreement does not stop Rockwell from paying dividends. This suggests they expect to remain profitable enough to continue returning value to investors. If Rockwell does something that violates the agreement, the lenders have the right to stop lending money and demand that all the borrowed money be paid back immediately. This is called acceleration. If Rockwell were to go bankrupt or become insolvent, lending commitments would automatically stop and any money owed would become immediately due. This is a standard safeguard for lenders. Beyond bankruptcy, other serious issues can trigger this acceleration. Things like not paying back loans on time, breaking important promises in the agreement, or if someone takes over the company without the lender's approval, these could all lead to the lenders calling in the debt. This document is just a summary. The full detailed agreement is attached as Exhibit 99. That is where all the nitty-gritty legal stuff is. It's also worth noting that Rockwell and the banks involved in this loan might do other business together. This could include things like interest rate swaps, which are used to manage risk associated with changing interest rates. This is quite common in the financial world. Exhibit 99 is the actual credit agreement itself. It details the full terms and conditions provided by Bank of America NA as the administrative agent for all the banks involved. Exhibit 104 is just the interactive data file for the report's cover page formatted in XBRL. This is for regulatory and data processing purposes. And finally, the signature section. This is where the authorized company officer confirms the report's accuracy. Rebecca W. House, the Senior Vice President, Chief People and Legal Officer and Secretary, has signed on behalf of Rockwell Automation Incorporated. The report is dated the 21st of November 2025, which is a few days after the actual agreement was made, as expected. So, what does all this mean for Rockwell Automation Incorporated? On the surface, this is a positive move. They've secured a significant line of credit, showing their access to substantial capital. The flexibility to increase the borrowing amount is a smart move, providing a safety net for future growth or unforeseen challenges. Replacing the old agreement with a new one indicates they are proactively managing their debt structure, which is a sign of good financial stewardship. The fact that they can still pay dividends is a big thumbs up for shareholders looking for income. However, we always need to look deeper. The interest rates are tied to their credit rating, so maintaining a strong financial performance is crucial to keep borrowing costs low. The covenants, while standard, do put some constraints on their strategic flexibility. The key metric to watch is that EBITDA to interest expense ratio. If that dips, it could signal trouble. For now, this seems like a strategic financial maneuver to ensure they have the resources to operate and grow without immediately jeopardizing their dividend payments. We will be keeping an eye on how they utilize this new credit facility and if their credit rating changes. Alright, accountants and investors, that is our breakdown of Rockwell Automation's latest filing. What is your take on these numbers and what they signal for the company's future? Drop your thoughts in the comments. If this analysis was valuable, hitting that like button really helps, and subscribe for more deep dives. Don't forget to check out the Discord in the description. Thanks for watching. See you next time.